Peace, blessings, and respect, family. I'm hollering at you this weekend just to give a heads up and a shout out, you know what I'm saying? But mainly a heads up. Now is the time when you really want to be getting your precious metals up. Your gold, your silver, your platinum, your copper, and I'm talking physical metals, physical. That paper stuff is on its way out. Don't fall for the, it's cool if you just trying to get some experience with dealing with ETFs and whatnot, but that's on its way out. And the thing is, you don't have to take my word for it. Listen to the experts. Check this out.
The world is not a good world now, sadly. And most people are not happy and they're not grounded because there are other scientific reasons for that also. The Earth's magnetic field is weakening continuously, and actually makes us less grounded, which is quite interesting. But but it goes hand in hand with the era we are in. So my view is evil is not a normal state. It is just it is a part of a cycle, and at the end of the cycle, this is what happens. In my view, and we are going to see at some point in coming years an implosion of the financial system, an implosion of world economy, and times will be tough for all of us. But I think at the same time we need a forest fire. We need this system to burn down because there's no other way of solving it. It can never be solved by debts will never be repaid. It's impossible. As we know, now we're in so-called prosperous times, and debts are exploding totally, increasing exponentially in prosperous times. So, what happens then when we get bad times? Well, they will of course increase even more, grow even faster, if that's possible, until everything implodes. Debt will be worthless, and of course that means that the assets that were financed by this debt will also be, if not worthless, worth a lot. They would be worth a lot less. And many bubble assets like stocks and bonds will go down by 90-95% in real terms. And I think that's necessary. We need that. Well, the world needs that. So we can get a good fire, clean up all the dead wood, and start again, and then we get back, and then we will get back to real values, families, etc., and community, which has disappeared now. So it's an interesting cycle, and the transition will be horrible for most people, of course. For all of us, it'll be horrible. Nobody will escape it. But after the transition, as I said, we will all have to work hard for and to create real things.
I want to update you on the Federal Reserve. The Federal Reserve, they've been printing a record amount of money, and they've been keeping interest rates at close to 0%. Consumer prices are rising at their fastest pace in nearly 40 years. The chairman of the Federal Reserve, Jerome Powell, was saying that the high rate of inflation, it's temporary, it's transitory. He was blaming it on supply chain issues. But in December, Jerome Powell, he finally admitted that he was wrong. Therefore, the Federal Reserve is taking significant action in order to fight inflation. So what the Federal Reserve is saying is so big that even I am in shock if they actually go through with what they're saying that they're going to do, and I'll let you know why. So the Federal Reserve, they want to stop the money printing completely by March. Right after that, so immediately after that, they want to start raising interest rates. So that's not the big shocker because that was what was expected. So not only are they going to stop the money printing and raise interest rates, they're also thinking about doing quantitative tightening. So quantitative tightening, that's when they remove money out of the system. So when you print more money, you're putting more money into the system. If you stop the money printing, you stop the money supply from growing any bigger, right? But what they're saying is that they want to go a step further. So not only are they going to stop the money printing, but they're going to suck money out of the system. So that's quantitative tightening. That would definitely put a hard stop on inflation. But it sounds like if they actually carried that out, it would trigger a really nasty recession.
40%, or kind of put their credibility aside and say, our job is really to keep asset prices inflated and keep the market going. That's not their job, but that's what they might choose. That would be a major loss of credibility for the Fed, in my opinion.
Well, if they have to taper faster than they wanted to, how does gold react? How does Bitcoin react? Because, gold, we have a track record of how it has reacted. This will be Bitcoin's really first run at this.
Yes. So I said last time we talked that I think gold market's not really going to work until the Fed gets serious about fighting inflation. They've started tapering. I don't think what they're doing is very serious, but they've started the process to get on that tapering chain. Gold's going to reassert its market dominance, I think, Daniela, once the Fed kind of oversteps. So is it the third taper, the fourth taper? Is it the first interest rate hike, the second one? What's the point that kind of tips the punch bowl over and causes rates to rise rapidly and kind of lose control of that bond market, of the interest rate yield curve, so to speak? When that happens, equities are going to roll over quite aggressively. Assets are going to fall quite dramatically. At that point, typically what the Fed will do is they'll come back in the market and say, well, sorry, we made a mistake. We went a bit too far. We're stopping interest rate hikes. We're maybe adding some quantitative easing back to the market. That's the point when investors realize the Fed can no longer control inflation. They no longer have the capacity either to choose between massive asset deflation or equity price deflation or inflation. The market, they're cornered. The market still believes they have the magic wand to get out of this corner. Once the market sees they no longer can get out and that they're choosing between, like I said, equity deflation or inflation, that's when the gold market should really start to assert itself. When you come back to Bitcoin, I've said this publicly, I don't think Bitcoin is gold 2.0. I don't think it's a store of value. I don't think it's a wealth preserver. I think it's a highly speculative instrument that trades like the NASDAQ triple QQQ ETF times 3. If you look what the Bitcoin price has done, Danielle, in the last 3 months, when the equity market's down 2%, Bitcoin's down 8%. When the equity market's up 1 or 2%, Bitcoin's up 4 or 5%. I've looked at Bitcoin's price behavior the last 5-6 years. Whenever the market's in trouble and the equity market is down hard, Bitcoin sells off 2-3 times as much as the equity market. So my view would be that Bitcoin's not going to be a good place to hide when the market starts to roll over. And we'll see what happens on the other side of it. But right now, it trades exactly like a tech stock or highly levered ETF to technology shares.
The thing you bring that up, because I've had other experts that say, well, Bitcoin will trade like Amazon. And if that's any, let's say, future indicator, well, it's a good bet to play right now.
I mean, Amazon's one of the most successful companies in the world. It's wildly, profitable and driving sales growth, revenue growth. I think the correlation between Amazon and Bitcoin is spurious in the sense that it trades like a risk-on speculative instrument that's tied to speculative pools of money that roll into technology. So my point is when the market rolls over, tech's probably going to lead to the downside. And Bitcoin is heavily tied to that group of investors. Same kind of group of investors are speculating on those same kind of assets. And so I really don't think Bitcoin's going to do very well in a downturn. And at that point, we'll be able to see who the true believers are at that point when they've lost 30-40% of their money in Bitcoin.
Housing market, where do we go from here?
All tied to the same question on interest rates. So the market's been feasting off of low rates. I think you're in Canada right now, Danielle, you see what equity, what real estate prices are doing in Canada, what they're doing in the US. They've been really, really strong. Again, tied to the fact that the Fed has basically been pinning rates at 1% or 0% for years and years while inflation is running hot, forcing investors into hard assets, forcing them to overpay for assets. So again, if you believe interest rates are going up, you've got to be a little more cautious on real estate. If you believe, like your previous interview had said, that they're going to get really serious about trying to get their credibility back and really try to get a control of inflation, then real estate could be extremely vulnerable. Because if 10-year rate goes from 1.5 to 3 to 4 to 5, what that does to affordability of real estate is extremely negative for the buyers. And therefore, prices will have to readjust lower to allow people to afford to stay in their homes and pay the higher mortgage bill. So I think all these asset classes, Danielle, are all kind of tied together. And they're tied to a rising rate market environment. And so if that's the case, that's why I'm a little bit cautious about asset classes going into 2022, because I think a lot of that's going to be under pressure as the Fed lets rates drift a bit higher in 2022.
You've given us a lot of incredible information here. So to bring it home, for the folks at home who are starting off this new year, and New Year's can be overwhelming for a lot of people. There's resolutions and they're looking at their finances and they're looking at their life and they're looking at the state of their health or whatever. So it can be a very overwhelming time. But if when it comes to your finances, what's your suggestion? How can you tackle it if people want to recalibrate or, just take some time to change what they're currently doing?
Great question, great idea. I would say if your investors have exposure to assets, if they're owner of assets, whether it be equities, bonds, real estate, they've probably done very, very well since COVID. It sounds perverse, but since the global pandemic is a rough time for humanity, most asset classes have increased dramatically in value. So if your viewers have made a lot of money in the last 2 years, whatever they're invested in, my firmly held advice to them would be to take some money off the table, cash in some of those profits, take some of your gains off the table and stick it in cash or physical gold and silver, and sort of come out of this big run feeling good about the last 2 or 3 years you've had. Do not get caught up in the cycle of greed that we're in now, which I've made a lot of money the last 2 or 3 years. I want to make even more in 2022. I've seen so many people in my career make a lot of money and then lose it all in a crash. So the best thing we could do is tuck some of that away, put it in an old school safety deposit box. Don't touch it. Have that discipline not to touch the cash until there's blood in the streets. And they'll feel really good about the last 3-4 years. Most people are going to ride this bubble up and they're going to ride it down. They're going to end up in the exact same place they were 3 years ago, having the same net worth they had before the market rose. So it's hard to do, but I would say have that discipline to take some profits, get some cash, stay liquid, and see what happens in 2022.
Sometimes you just
real money typically during these kinds of periods. So during skyrocketing hyperinflation, then everybody really gets that the currency is dead, that the currency is losing value very quickly because the prices can double or triple or quadruple in 24 hours or whatever that number is going to be. We'll find out then. So is there some reason the tamping down of gold will not, silver and gold will not continue? And the answer is yes, because the markets, the real markets themselves will be driving that price and they will lose control. Now, we could be, I'm not going to make this statement purely yet, but if you look at what's happening today in the markets with the interest rates starting to spike, which they've been doing since the first of the year, right, particularly, well, but the Fed doesn't want them to spike. They want to gauge and regulate how they move up in price. So how come they're not doing that? Because the markets can overwhelm them. And that's what will happen during that period as well.
Present value. When you begin to intermediate the bond holdings of the biggest institutional investors in the world because of negative real interest rates, you will see a move into tangible assets that will make the silver squeeze, the alleged silver squeeze that we just went through, look silly. Now, the second part of this is a really interesting thing. I've invested a lot in it, and I don't really know what I'm doing. That has to do with the application of the distributed ledger and blockchain on the trade in gold and silver. I really do believe that eventually most savings and investment activities will switch from markets to the blockchain and the distributed ledger. The idea that you could have a storage intermediary, I would love to see it be Sprott, of course, but there will be various trusted storage intermediaries that develop precious metals and precious metals related tokens, which are effectively frictionless, and where trust in the exchange is community based via smart contracts. I think if you eliminate the friction that's present in precious metals, that precious metals again return to being money. I actually believe that the time will come very shortly, 5 or 6 years from now, when you can use a fraction of a silver coin to buy a cup of coffee, and that you can move precious metals back into being simultaneously a store of value and a medium of exchange.